A man sits in a mahogany-paneled office on the 42nd floor of a glass tower in Midtown Manhattan. He isn't filling out an application. He isn't waiting for a loan officer to check his credit score. In fact, he isn't asking for anything at all. The bank has come to him. They are offering him a line of credit at a rate lower than the inflation target of the central bank. They are offering to manage his daughter's trust for a fee that would be considered an accounting error at a retail branch. They are treating him not as a customer, but as a sovereign entity. Meanwhile, 3 miles away, a woman is charged $35 because her account balance dropped to $9.99. She is being penalized for not having enough money to be profitable for the institution. The math is simple, brutal, and almost never discussed in polite company. There are specific, invisible thresholds where the physics of money literally flip upside down. Most people spend their lives playing a game where the friction is high and the rewards are taxed at every turn. But at certain net worth levels, the friction disappears, the taxes become optional, and the banks stop being predators and start being servants. This is the breakdown of the levels where the rules quietly change. Before we dive into the specific math of these thresholds, it is important to note that the institutions that manage the world's capital rely on the general public not understanding these shifts. If everyone understood how the mechanics of wealth changed at the top, the political and social pressure on these systems would be untenable. This channel is dedicated to stripping away that veil and looking at how money, banking, and power actually operate. If this kind of institutional analysis is valuable, consider subscribing to the channel now. Understanding the game is the first step in seeing the board clearly. The first level is the $0 to $100,000 range. In financial circles, this is often called the survival or transactional phase. At this level, the primary relationship between an individual and the financial system is one of extraction. The math here is punishing. For someone with $5,000 in a savings account, the interest earned is negligible, often less than 0.1%. However, if that same person overdraws that account, the bank charges a fee that represents a 300% interest rate on a 24-hour loan. The systemic reality is that it is expensive to be poor. The friction is everywhere. There are fees for not having a high enough balance, fees for using the wrong ATM, and interest rates on credit cards that hover between 18 and 30%. Psychologically, people in this bracket are often forced into short-term thinking because the system demands it. When a car breakdown can wipe out a month's wages, the ability to plan for a 10-year horizon is a luxury that doesn't exist. The critique here is that the retail banking sector is essentially a giant vacuum designed to suck small amounts of liquidity out of the bottom 80% of the population to fund the operations of the top 20. It is a volume game. The banks don't make much from any one person at this level, but they make billions from the collective friction of millions of people. Then there is the shift that happens at the $100,000 to $1 million mark. This is the mass affluent trap. This is the level where the system begins to offer premium services. You might get a dedicated phone line or a card made of a slightly heavier metal, but the reality is that the rules haven't actually changed yet. The marketing has just become more sophisticated. At this level, the financial industry views the individual as a prime target for high-fee products. This is the realm of the 1% assets under management fee.
Now, one might think that 1% sounds like a small number, but the math tells a different story. If an account grows at 7% a year and the advisor takes 1%, they aren't taking 1% of the money. They are taking nearly 15% of the annual gains. Over 30 years, that 1% fee can devour up to a third of the total wealth that would have otherwise accumulated. People at this level often feel like they've made it because they have a 6-figure or low 7-figure portfolio, but they are still participating in a retail system. They are the high-value prey. The institutions provide the illusion of exclusivity to keep the capital locked in high-friction environments. The first real quiet change in the rules occurs at the $1 million to $5 million threshold. This is the entry-level private banking stage. This is where the physics of debt begin to change. For a retail borrower, debt is a burden, a monthly payment that drains cash flow. But for someone with $5 million in liquid assets, debt becomes a tool for liquidity without taxation. This is the emergence of the pledged asset line, or PAL. What tends to happen is that instead of selling stocks to buy a house or fund a lifestyle, which would trigger a capital gains tax, the individual pledges their portfolio as collateral for a low-interest loan. If the portfolio is growing at 8% and the loan interest is 5%, the individual is effectively being paid to borrow money. They get the cash they need, their assets stay invested and continue to compound, and they owe no taxes because a loan is not considered income. This is a mechanism that is simply not available to someone with $50,000. The system allows those with significant assets to bypass the tax realization events that slow down the wealth accumulation of the middle class. The physical analogy here is moving from a headwind to a tailwind. In the lower tiers, every move you make is resisted by the system. At the $5 million mark, the system begins to push you forward. Why does the bank do this? Because at this level, the bank isn't making money from fees. They are making money from the spread on your assets and the long-term relationship. They want to ensure your capital never leaves their ecosystem. Moving into the $5 million to $25 million range, we enter the world of true private banking and the ultra-high net worth, UHNW category. This is where the psychological shift from growth to preservation in power becomes dominant. At this level, the individual stops being a consumer of financial products and starts being a participant in institutional-grade opportunities. The math changes here through access. A person with $10,000 is limited to the public markets, stocks, bonds, and ETFs. These markets are highly regulated, but also highly efficient, meaning it is difficult to find an edge. However, at the $25 million level, the doors to private equity, venture capital, and direct real estate placements swing open. These are opaque markets. In opaque markets, information is not perfectly distributed. Those with the right connections and the right amount of capital can access returns that are mathematically decoupled from the volatility of the S&P 500.
Furthermore, the legal and tax structures change. This is the level of the family office or the private trust company. The individual no longer owns things in their own name. They own entities that own entities. This isn't just about hiding money. It's about structural permanence. At this level, the goal is to make the wealth sovereign, meaning it is insulated from personal liability, divorce, or changes in the political climate. The systemic critique here is that the law is written for people, but the loopholes are written for structures. By moving wealth into these complex structures, the ultra-wealthy effectively opt out of the legal and tax frameworks that apply to everyone else. Now, you might be thinking that $25 million is an unreachable sum, and for the vast majority of the population, it is. But the point of understanding these levels isn't just to marvel at the numbers, it's to see how the logic of the system evolves. The reason these rules are quiet is that if the average worker understood that a billionaire can borrow $50 million at 3% interest to buy a yacht, while the worker pays 19% on a credit card to buy groceries, the perceived fairness of the economic contract would collapse. The system relies on the assumption that the rules are the same for everyone, just on different scales. But the math shows that the rules are fundamentally different in kind, not just in degree. The next threshold is the $25 million to $100 million level. At this stage, the relationship with the state begins to change. Wealth at this level is no longer about lifestyle. No one can eat $25 million worth of food. It is about influence and the ability to shape the environment. People in this position often find that the cost of things becomes irrelevant because their capital generates more alpha than they can possibly spend. Consider the buy, borrow, die strategy. This is the ultimate expression of the rule change regarding debt. An individual with $80 million in assets never has to earn another dollar of taxable income for the rest of their life. They can live entirely off lines of credit secured by their growing assets. When they die, their heirs receive a step up in basis. This is a quiet provision in the tax code, where the value of the assets is reset to the current market price at the time of death, effectively wiping out all the capital gains taxes that would have been owed. The debt is then paid off by the estate, and the remaining tens of millions are passed on to the next generation, tax-free or heavily shielded. This is how dynasties are built. It is a mathematical loophole that allows wealth to compound across generations without ever being clipped by the friction of the tax system. Beyond $100 million, we enter the realm of the centimillionaire and the sovereign wealth. At this level, the rules of finance merge with the rules of geopolitics. When someone has this much capital, banks do not just offer them loans, they offer them bespoke financial instruments. They might create a customized derivative that hedges against the specific risks of the individual's business interests. They might provide access to dark pools of liquidity where massive trades can be made without moving the public market price.
The physical analogy here is the difference between a person swimming in the ocean and a person owning the ocean. At the lower levels, you are subject to the currents. At this level, you are the current. The psychological reality is that money is no longer a medium of exchange, it is a form of energy. It is used to lobby for regulatory changes that protect the individual's interests, ensuring that the moats around their wealth remain unbreachable. The critique here is that at the very top, the market is no longer free. It is a managed environment where the biggest players coordinate with central banks and governments to ensure stability, which is often a polite word for maintaining the status quo. But why is this information rarely discussed? Why isn't this taught in schools or explained by financial news outlets? The answer lies in the profit motives of the institutions involved. Retail banks profit from the ignorance of the bottom tiers. If people understood the cost of carry on their debt, they might behave differently, reducing the bank's interest income. Investment firms profit from the mass affluent trap. If people realized that a simple index fund would outperform their high-fee wealth advisor over 20 years, the entire mid-tier financial services industry would evaporate overnight. Furthermore, the ultra-wealthy have a vested interest in the quietness of these rule changes. Visibility brings scrutiny. If the mechanisms of buy, borrow, die, or pledged asset lines were common knowledge, there would be immense public pressure to close those loopholes. The silence is a strategic choice. It maintains the illusion of a meritocratic ladder, while the people at the top are actually using an elevator that the people at the bottom don't even know exists. Let's look at the concrete math of a specific scenario to illustrate how these rules diverge. Imagine two individuals. Person A has $50,000 and person B has $50 million. Both want to spend $1 million on a piece of real estate. Person A cannot do this. They are limited by their current capital. They must spend years saving. And if they take out a mortgage, they are subject to the prevailing retail interest rates, credit checks, and the requirement of a steady income that is taxed at the highest marginal rates. Their $50,000 is a static asset. It does nothing but sit there, perhaps losing value to inflation if it's in a standard savings account. Person B, however, does not spend their money. They go to their private bank. They pledge $2 million of their $50 million portfolio as collateral. The bank gives them a $1 million loan at a rate of, say, 3.5%. Person B buys the property with cash from the loan. Now the property itself is an asset that might appreciate or produce rental income. Meanwhile, the $2 million that was pledged as collateral is still invested in the market, potentially earning 7 or 8%. The math of Person B's move is staggering. They are paying 3.5% to the bank, but they are earning 8% on the same money in the market. They are making a 4.5% spread on the bank's money. They have acquired a $1 million asset without reducing their net worth by a single penny. In fact, their net worth is increasing because of the debt. For Person A, debt is a drain. For Person B, debt is a multiplier. This is what is meant by the rules quietly changing. It isn't just that Person B has more money, it's that the math of their life operates on a different set of axioms.
This brings us to the concept of velocity of capital. At the lower net worth levels, capital has a very low velocity. It comes in as a paycheck, sits in a bank for a few days, and then leaves to pay for expenses. It doesn't work. It is merely a placeholder for labor. As net worth increases, the velocity of capital increases. Money is moved between entities, used as collateral, reinvested, and shielded from taxes. By the time you reach the $10 million mark, every dollar is doing 3 or 4 jobs at once. It is providing liquidity, it is serving as collateral, it is growing through investment, and it is providing a tax deduction through interest payments. Now, the systemic critique of this reality is that it creates a K-shaped financial physics. For those of the top, the system is designed to prevent loss and accelerate gain. For those at the bottom, the system is designed to harvest fees and maintain a certain level of precariousness. Precariousness is profitable. A person who is living paycheck to paycheck is a person who will pay a convenience fee, a high interest rate, and a late penalty. A person with $50 million is a person who will move their entire account if the bank charges them a $10 wire fee. Thus, the bank competes to give the wealthy person everything for free while charging the poor person for every breath they take. Now, some might argue that this is simply the way of the world, that those with more capital take more risk and therefore deserve more rewards. But the data suggests that at the highest levels, the risk is often socialized while the rewards are privatized. When a major hedge fund or a private bank faces a systemic crisis, the state intervenes to provide liquidity. When a retail borrower faces a crisis, they are foreclosed upon. This asymmetry of risk is the ultimate rule change. At a certain level of net worth, you become systemically important. Your failure would hurt the bank or the economy more than it would hurt you. This is the ultimate get-out-of-jail-free card provided by the financial system. One must also consider the psychological impact of these thresholds. Research into the psychology of wealth shows that as people cross these invisible lines, their perception of the other changes. At the lower levels, there's a sense of being in it together against a harsh system. But as individuals move into the private banking and family office tiers, they begin to view themselves as separate from the general economy. They stop caring about the retail inflation rate because their assets inflate faster than their costs. They stop caring about public infrastructure because they use private alternatives. This creates a feedback loop where the people with the most power to change the system have the least incentive to do so because the system is working perfectly for them. The transition from $100 million to $1 billion is perhaps the most profound, though it applies to an infinitesimally small number of people. At this stage, money ceases to be a tool for personal or even familial use and becomes a tool for civilizational influence. This is the level where individuals start foundations that have larger budgets than the health ministries of mid-sized nations. They fund think tanks that write the very laws we've been discussing. They acquire media companies to shape the narrative about wealth and taxes. At the billionaire level, the rules don't just change. The individual becomes a rule maker.
The critique here is that this level of wealth is fundamentally incompatible with a democratic framework because the mathematical power of $1 billion can overwhelm the collective voice of millions of voters. The financial system doesn't just treat you differently, it begins to orbit around you.
But let's bring it back to the more common thresholds, because that is where the most practical, quiet changes occur for those climbing the ladder. Between $1 million and $10 million, the most important change is the shift from active to structural wealth management. This is where people often realize that they have been working for their money, but their money has not been working for them. The pattern that emerges is one of consolidation. People at this level tend to fire their retail brokers and move to independent registered investment advisors, or RIAs, or multifamily offices. Why? Because they realize that the premium service at a big bank is often just a sales channel for the bank's own products. An RIA has a fiduciary duty to the client, not the bank. This shift in loyalty is a key rule change. Suddenly, the person at the table is on your side of the ledger, looking for ways to reduce the bank's take. They look for institutional share classes of funds that have lower internal expenses. They look for tax loss harvesting strategies that are automated and aggressive. They move the individual from being a consumer to being a client. The physical analogy here is the difference between buying a suit off the rack and having one custom made. The off-the-rack suit, retail banking, is designed to fit most people poorly. It is mass-produced for the benefit of the manufacturer. The custom suit, private wealth management, is designed to fit your specific contours, your tax situation, your family structure, and your risk tolerance. The tragedy of the system is that the custom suit often costs less in the long run than the off-the-rack one, because the off-the-rack one comes with hidden alteration fees, hidden bank fees, that never end. Another quiet change happens in the realm of access to information. In the retail world, you get your news from the television or the internet. By the time you read that a certain sector is a good investment, the smart money has already bought in and driven up the price. You are the exit liquidity. But at the $5 million plus level, information flows differently. You are invited to investor days for private companies. You sit on boards. You have a network of other high net worth individuals who share information about what they are seeing in their respective industries. This isn't necessarily insider trading in the legal sense, but it is informational advantage. The system is structured to reward those who already have the most information. The critique is that the fair and transparent public markets are often anything but. They are the place where the retail public is invited to play a game after the rules have already been set, and the best cards have been dealt to the private players. So why is this information so rarely discussed? It is because the clarity of this math is a threat to the stability of the hierarchy. If everyone knew the exact thresholds where the rules changed, they would stop playing the retail game. They would demand a leveling of the physics of money. But the financial system is built on layers of obfuscation. It uses complex jargon, collateralized loan obligations, stepped-up basis, carried interest, to make these simple mathematical advantages sound like complicated, necessary parts of a functioning economy. In reality, they are just ways to ensure that capital stays at the top and friction stays at the bottom. The reason the woman at the beginning of this script was charged $35 for having a low balance is the same reason the man on the 42nd floor was giving a low-interest loan. The system is designed to reward the possession of capital, not the effort of labor. The more money you have, the cheaper it becomes to have it. The less money you have, the more expensive it is to exist.
Understanding these thresholds, the survival phase, the mass affluent trap, the private banking shift, the family office sovereignty, and the institutional power level, allows one to see the world as it actually is, rather than how it is marketed. The rules of money are not a single set of laws. They are a series of phase transitions, like water turning to steam. At each level, the properties of the substance change. The pattern is clear. At the bottom, you are the product. In the middle, you are the prey. At the top, you are the partner. And at the very top, you are the architect. The system relies on the majority of people staying in the first two categories, providing the fees and the labor that fuel the advantages of the last two. This is the quiet reality of net worth levels. It is a world of invisible fences and velvet ropes, where the math of your life is determined by which side of the line you stand on. This channel exists to point out those lines, to show the math, and to explain why the institutions would prefer you didn't know they existed. If you find this objective, observational look into the mechanics of wealth valuable, ensure you are subscribed. The more people who understand the board, the harder it becomes for the players to hide the rules. Close the door on the marketing and the noise. Look at the math. Look at the structures. That is where the truth of the system resides. This information is rarely discussed because the system is designed to be lived in, not looked at. But once you